Trend lines, how to draw them, how to understand them, and how to use them to give you a bit of a trading edge. All right, so why do traders use trend lines? Trend lines give you a slight edge because it allows you to trade with the move of the market. So if we're just looking at this market and say we're a non-biased trader, say we can trade up and down in the market, and we draw a trend line. This is very rough. We're going to expand on this more as we go up. But, well, what do we see? We see the market is going downwards. Now, trend lines are a lot more advanced than that, and we're going to get into that. But the idea of trading with the flow as an individual home trader, somebody who doesn't trade big money, it's really important to go with the flow because you're not a market maker. You're not making this market move up or down with however many contracts or however many pips you're going for on Forex, or if you're trading stocks. You're just looking to get on with the larger movement and then trade with that movement. So having that ability to see, identify, and then start trading with the trend. So if we're on this market and say we want to trade this market. Now, which side is better to be on? Even if I'm talking about even if you're trading intraday here, like say you're trading intraday here, this is a daily chart right now. And even if you're trading intraday, at what point do you want to be on the upside or the downside of this market? You can use trend lines to give you a better understanding of when the market is more likely to reverse or be headed down, or if it's more likely to be going up. Even with a downtrend like this is a market is going downwards. We can take that, and with the bounces, because there's always going to be a bounce between the buyers and the sellers, there's always going to be a change of control from sellers get in control, buyers get back in control, sellers get in control, buyers get back in control. That's a market. We're not going straight down. But we can use the trend line to get a better understanding of what side and when we should be on the market. It's just a lot easier to make money when you're trading with the trend. If you're trading against the trend, you're taking in no consideration. Like, we're on a daily chart, but if you're trading the 30-minute chart and we start to see levels reapproach a trend line, well, if we were trading up in that market, assuming that we're waiting for another retest of that trend line, then why wouldn't we want to start considering shorts? All right, we're going to have to take a step back and get a bit more into trend lines and break down exactly what they are. First off, trend lines do not offer support and resistance. That's a mistake I see made by a lot of traders, and even I'll make that mistake when I'm talking about it, but trend lines are not a support and resistance indication. So we'll draw this trend line again. It's a down, not an overly aggressive trend line. So what do we see? We see between this point and this point, the market went down, and between this point and retest of the trend line, the market went down, and again, it went down here. So each of these reversals, when it retests this trend line, is not a test of support and resistance. A test of support and resistance is a test of an area where there's agreement between buyers and sellers. So if we say, take this, so we're using the highs, the absolute highs of the days here and here. Because at that point, that specific price point, buyers and sellers were in agreement that is as high as they're going to let the market go. More important level would be the closes, and the closes here, where you can also see the closes here are very close. Close closes here and very close closes here. This whole area is a level of support and resistance, support or resistance. If the market breaks above, it's support. If the market's below, it's resistance. So this area of resistance in the market, if the market retests it right here, is something to pay attention to. Whereas, we'll clean up these indicators. If we're looking at this trend line here, so if we're looking at this trend line, again, this is just extremely roughly drawn. I'm just doing it to illustrate a point. The area here where the market retests the trend line, well, it is where it forms, and then it retest and then another retest here. All three of these areas are not levels of support and resistance. They're simply areas where the market has reversed because of the trend line. Well, why is that? That's because a trend line represents expected moves in the market. It's not a support and resistance level, it's an expected move. So the sellers have an expected move downwards in the market, and that's what the trend line, and the buyers are attempting to test and break that. But that's what the sellers are looking at. They're not looking at the support and resistance of the trend line, they're looking at the expected move. The sellers want to make money, and this expected move is just confirmation of the fact that they were on the correct side of the market. They had the correct idea originally to go short, and that this idea is coming to fruition. And they can see with multiple retests of that trend line, not the retest of support, but of the trend line, it shows that their initial idea or theory on the market is correct. The theory is to do with how fast the market will bounce back, because unless the market is completely tanking for some external reason, generally the markets will bounce between levels. And the degree of that trend line is how much they expect the market to move down over a period of time. Like, we look at this trend line and we just carry it forward. The expectation of the sellers is that the market will again break this low, and not that the market will just run down to nowhere, but they expect it to break the low, reverse, and then again possibly retest. And every time this market retests this trend line or gets anywhere near it, just shows improved strength in the downward move. We have a little bit of a unique situation happening here, but that's a little bit more of an advanced topic. You can see that what's happened is we've actually broken the current quote-unquote trend of consistent down, up, down, up, down, up. There's a little bit more, you can see a little bit more push upwards in the market. We got to just take a little step back, and how do you draw a trend line? Well, let's just start drawing lines. So we have the trend line that we have been drawing, and then we could do another one from the tops here, or we could even do one from here. Now, the difference between these three lines is huge, and the degree of a trend line is also quite important. So with our first example here, when we look at it, it's consistent, it's not overly aggressive, and our second trend line is a lot more aggressive and a lot harder to sustain. So the harder the angle, the harder it is for the market to sustain that trend downwards. That's why when we look at our third trend line, it's an unsustainable level. If this market continued in this fashion, and we can see it was immediately broken because this is completely unsustainable. If a trend line's this aggressive, the market would have to be completely tanking for external reasons, like a complete wipeout of epic proportions. But that's such a special circumstance. That's not what trend lines are for. Trend lines are here to show a general trend in the market. On this exact same example, well, why don't we draw a trend line up? So why right here, when we get a high here, why don't we start drawing trend lines as the market progresses upwards? And that looks incredibly messy. Let's clean this up. So why don't we start drawing uptrend lines? Well, these aren't incorrect in this extremely short time frame because the market was starting to make an up move. But as we've talked about before in multi-time frame confluence videos, the higher time frame or the larger span of time is always going to be dominant over the smaller time frames. So The reason we don't draw trend lines like this when the market immediately starts moving up is because the dominant time frame that we're looking at, the higher time frame, whatever that may be, is going to generally hold truer. So it's a lot easier for us when we're trading this market, and it makes a lot more sense in the long-term outlook to draw our trend lines always following the greater trend of the market. So the higher time frame will always hold truer. And here we're looking at actually the entire year, starting at the beginning of 2017 moving forward. So this is a very large time frame. We can go down into smaller time frames, but the larger time frames really do illustrate trend lines the best. Generally, we want to avoid trend lines in anything sub 60 minutes as a general rule, because sub 60 minutes, you start getting a lot of extra noise happening in the market, and it just makes it incredibly difficult to work with trend lines there. They just mean a whole lot less. The higher time frame you go, the more each trend line will quote unquote mean. When the market bounces off of these levels, it's a lot more significant than when it bounces off of a 5-minute chart or a 15-minute chart. Now, something very specific about drawing your actual trend lines, we're going to clean up the one we've been doing, is where to actually draw your trend line. So this is a down market. We've established that it's as a whole, it's a down market. There are uptrends in it, but in the end, it is a general down market. We can draw trend lines in a few different ways. Say we take the peak of this candlestick here, and then we go to the peak of the next candlestick. That's good information, and sometimes I will draw this as a trend line, but one of the things that you might want to consider is what is actually happening during these days. What's actually happening when the market is peaking during these days? Well, an intraday peak can often be just a quick rush, a rush for the gates, where the market just pushes itself up as high as it can go. This goes for down as well, as you'll see here. This goes all the same for down. It's a mad push down in the market, and it doesn't actually properly represent the general consensus on the price, the correct price, quote unquote, of the market. So when we draw through the tips of the wicks or candlesticks, it can cause problems because we're not getting the most, trend lines are going for a general take on the market, a general up, down, expected moves in the market. If we're drawing through the tips of the wicks here, that's not a general move. That's more of a immediate spike in price. So what we want to do when we draw the trend line is actually draw through the meat of the trend line. So that's the opens and the closes. That's as high as the market got and was able to close out. This goes for anything from daily, weekly, or if you're going down to 60, look for the closes. We're not dealing in small time frames here that are extremely spiky. We're dealing in the higher time frames when we're drawing the trend lines, even if we're trading the lower time frames. So we want to draw through the meat of this candlestick. So the actual where the market closed to the next meat of the next candlestick. So it gives us a bit more of an accurate representation. Now, is it a problem when we see this market and we see that the market didn't quite reach this trend line here and it hasn't quite reached it here? It's not really a problem because, like we said, these aren't specific levels where traders have actually been making transactions and have agreed on price at these levels. This is just an expectation of a move in the market. I hope this gives you a better understanding as we've gone over how to draw trend lines, through the meat of a trade, what they represent, and in the fact that they don't represent support and resistance, and that they represent expected moves in the market, and over how aggressive to draw your trend lines. Do you have any trading topics that you'd like covered? Leave a comment below and we can dive deeper into all things trading. If you just enjoyed the video, please subscribe or leave a like.